Welcome back to our Chapter 3 video lectures. We are going to now pick up on our Objective 3.3, where we are going to look at two different balance sheet liability classifications, current being one of those, and non-current or long-term being the others. And basically with current, we are saying that this obligation is expected to be satisfied through the use of current assets or other current liabilities. So we're saying current assets or current liabilities, which is about 1 year or less. So expected to last within 1 year. So examples are usually accounts and notes payable, types of deferred revenues, accrued liabilities, and then the current portion of long-term debt. So accounts payable arises from the process in which you as a company purchase items from a supplier and they're purchased on account, so you get credit terms. So opposite of accounts receivable, where you as a company are giving customers credit, now your vendors are giving you credit, and that's accounts payable. The common payment terms are 30 to 60 days. So the difference between accounts payable and notes payable is that notes payable is a written promise. So in accounts payable, all you basically have are just the invoice with the net credit terms on it. And in notes payable, there's a written agreement and it has explicit payment terms. There's also interest associated with it, and in addition to your original obligation. So if you have a note for $80,000, then you might have 10% interest and it might be due in 2 years. So that's a very typical term. Current liabilities are such as deferred revenues. That represents cash that you did receive from a customer, and then it's a liability because you are liable to the services provided in a future period. Gift cards are very common. Any type of, so you purchase a gift card from Best Buy, you give Best Buy the $100, so Best Buy records that as a debit to cash for $100 and a credit to deferred revenue. Then you go in and you're doing your Christmas shopping, and then you actually redeem that $100. So they would debit then Best Buy deferred revenue for the $100, and then they would credit sales revenue for the $100 for whatever it is that you purchased. So that's a very common example. Accrued liabilities, though, now are when it's an obligation, so it's still something that the company owes. And then here your expenses have been incurred, and remember, we record expenses when incurred, but they're not paid yet. So the issue here in deferred revenues, you get cash. In accrued liabilities, you basically have to pay the cash. So in this case would be maybe your accrued salaries, accrued interest, taxes. So here you have current maturities of a long-term debt. So you have $1 million note payable, which requires $100,000 in principal payments to be made in each of the next 10 years. So in this case, you basically have $100,000 that is due the next year. So this is your current portion, and then your long-term portion is the other 9 years. So here you would have notes, mortgages, bonds, and we're going to talk about bonds in intermediate accounting too. So long-term liabilities is basically you will not be satisfied within the next year. So it obviously takes longer than 1 year. You don't use your current assets or current liabilities for these payments. It does impact future cash flows and our long-term solvency. So we just have to be careful. We also will talk about the debt to equity ratio. And that is something that will take into effect all of our long-term notes, our bonds, our pension obligations, and leases. All of these items, bonds, pensions, and leases, are all part of intermediate accounting too, so what you have to look forward to. So now we're looking again at PetSmart's balance sheet, and we see the liabilities, such as accounts payable, our accrued payroll bonuses and other benefits. We have occupancy expenses, and note you'll have current maturities on long-term debt. Then we have our capital lease, our deferred rents, and other non-current liabilities. So this is a great real-world example of what you might see out there in our balance sheets. So now we have shareholders' equity. So we have additional paid-in capital, and we have retained earnings. And basically, we have now assets minus liability equals our shareholders' equity or our owner's equity. And basically, in these pieces, you'll see that there are, let's go back to that a second, you'll see components, and we're going to have other comprehensive income. So we're going to actually talk more about that as we progress through intermediate 1 and 2. So here you see we have common stock. There's also preferred stock usually, but now here we have common stock. Here is our additional paid-in capital, our retained earnings, and then our other comprehensive income or loss. Then notice you see less our treasury stock. Treasury stock is where you're actually purchasing back. You as a company purchase back your own stock. Now, we move on to the purpose of our financial statement disclosures. Financial statement disclosures are mandatory and they are required by GAAP. So you need to do these for GAAP. And basically what it is additional information that you just can't put in the total face of the financial statements. So examples include, we'll go through some of these, but right, uncollectible accounts, right? We produce our gross receivables less, so we have gross accounts receivables, less allowance for doubtful accounts gives us our net realizable value. So in this case, we would actually show maybe the net and show that actual, both of these items in our disclosure notes. So it's there for explaining what we have on the financial statements, and it just gives us several types of schedules. So for example, for leases, you may show the obligation that's current and what's going on longer term. For property, plant, and equipment, you might break it down by all the various categories and note the categories, what depreciation method is used, what's the average useful life, and salvage value. Then there are specific notes, disclosure notes that have to be part of the financial statements. The first one usually being summary of significant accounting policies. And another disclosure note is subsequent events, anything that's happened after the company's fiscal year, but prior to the issuance of the financial statements. And you might also have to say any loss contingencies or contingent liabilities, which we're going to talk about in intermediate accounting too, as well. So related party transaction is also a very big intercompany transactions, which is basically if you have a subsidiary and those types of, if there's ever any error, fraud, or illegal acts, this is also very bad. So that would just give you such a big issue. Another area that we have is our management discussion and analysis, MD&A. And here is what you're doing is usually the CEO gives a perspective on the company's operations, maybe what capital resources they plan on using, what type of liquidity they have. It's usually included in the annual reports of a public company. So that's known as a 10K. Remember, a 10Q is quarterly reports. And basically here, what happens is there's a management responsibility section, which tells us that the management is responsible for the internal control procedures and what management's responsibilities are. This is also depicted in our audit opinion. And then Sarbanes-Oxley now requires the corporate executives, namely the CEO and the CFO, they personally have to certify that the financial statements, and they also have to certify that internal controls are in place and that they are effective. So this concludes this portion of our video lecture for chapter 3. Please go on to the next one.